Good morning, folks. Welcome back. Happy Monday. And we're starting off the week with some disruption down south. If anyone has kind of seen any of the sort of international breaking news headlines over the last day or so, the tension and the focus in anything electoral, anything macro or political has been Argentina. So Argentina for the last 20 years has been in a perpetual financial crisis. They've gone from administration to administration, surviving, of course, a global financial crisis, going through a lot of volatility in energy, in materials, in oil. Argentina is a very oil rich country. It has one of the largest deposits known to man, known as Vaca Muerta, or dead cow, which has been kind of this, you know, continuously promised boon that hasn't quite materialized, but remains incredibly valuable. It's a very resource rich country. It is a very well educated country. It has kind of a strong business and investing infrastructure and sort of knowledge base. If we look at it that way, like a lot of talent, a lot of sophisticated, almost legendary investors for the region coming out of Argentina, and fantastic entrepreneurs as well. And unfortunately, the citizenry has dealt with mismanagement, financial mismanagement, Argentina defaulting on several debts on a sovereign basis, meaning that the government itself borrowed money from the rest of the world, from the World Bank, from the IMF, from trade partners, et cetera, and has not repaid that debt several times over. And each time that an international organization gets involved, they ultimately get smoked and they don't get their repayment back. So the citizenry, the population of Argentina is tired. They're exhausted from their leftist kind of camp that has entrenched in kind of multi-generational political leadership, and then the extreme right, which has had its moments, but is still part of that narrative of financial hardship. So now Argentina is seemingly bringing in an outsider. The world is sort of calling him a Trump acolyte. Miguel, let me pronounce his name correctly, actually. Trying to pull up the exact spelling here, but Millet, outsider Millet, takes 30% of the votes with 97% of the ballots counted. This is the the primary election, and the market was not expecting this. In fact, multiple people who I know in the industry who cover Argentina specifically or have a large clientele of Argentinian investors are calling for, hey guys, this is a time to maybe pause on domestic investment or even liquidate. This morning we saw the dollar denominated bonds of the Argentinian government collapse. So as almost as usual, the international market is very surprised by this turnout. But it is not surprising when you zoom out over the last 20 years and you try to understand what governments have done for the country. And, this is a country that's dealt with hyperinflation for the last several years, had a horrible time in COVID, has price restrictions, currency exchange restrictions, several business restrictions. It's just been an absolute nightmare of a swinging pendulum of administration from conservative to leftist socialist, back and forth without too much result. So it makes a lot of sense for the country to elect somewhat of an outsider, somewhat of a political bureaucrat or career bureaucrat, technocrat, what have you. But the market is not loving it. They're not loving it. They're viewing it as kind of a Trumpian type takeover. So this takes us to puppies and Rolex. So, as you know, we love to look at economic indicators. I always love to kind of have these boots on the ground comments where, I'll see something in public and I'll share it and kind of denote the time and place that it occurred, and then kind of overlay macroeconomic data or market data later down the road and use that as kind of a timeline. And it's very, very fun to bring in anecdotal and kind of real world stuff into our observation of the market. But puppies and Rolex, I mean, Bloomberg wrote an article about it, I think yesterday, where they're pointing at these two items as the buck breaking as far as any sort of euphoric spending, overpriced, kind of overhyped luxury spending. During pandemic, these were two items that were highly sought after and saw insane price inflation, especially the Rolex market. I've always been a watch fan, and during pandemic, just the prices kept going up and up and up and up. Some of the most sort of baseline sporty models were fetching above, $10,000. In the case of a Rolex Daytona, you were seeing some of them, $50,000 or even more. So these prices have imploded. They have retreated massively, and I think that's kind of giving us the indication of where the particularly the American consumer is starting to call it quits. They're not necessarily willing to pay premiums for things that they know aren't worth a premium, in exchange for timeliness or having access to it instantly or getting the one that you want because there's a supply issue. Supply issues have been predominantly fixed post-COVID. Prices have gone up with inflation, not just because of euphoria or high demand. And the consumer is saying no, no mas, no mas, on prices of Puppies and Rolex. And then, we were watching the market over the last week. It's been a little bit of back and forth as businesses have reported earnings, and some companies like the WeWorks of the world, the Home Depots of the world, have pointed to the rest of the year and perhaps into next year and said, this is not going to be smooth sailing necessarily, and we have to re-examine our business to understand how to navigate this. WeWork in particular, we've talked about it several times over the last week, very concerned that they'll be able to continue as a going concern, and that ties into those fears on commercial real estate. Mind you, WeWork is the most retail of commercial real estate, right? Because they're selling small plots at a very small premium to a lot of individuals. So it's a fairly, intensive business with high churn, and has to be very careful with its pricing with such sort of inexpensive and low volume customers. So it makes sense that that's kind of where the music is stopping first. We'll continue to watch the scene of the large banks, the large consulting firms, law firms, and how they navigate their commercial real estate mixed with back to office mandates. So we continue to see a little bit of nerves within the U.S. market, driven largely by earnings in this last season, driven largely by the worries of inflation and how that's going to be navigated. But the good news is that last week we got the CPI report, we got the purchasing price index report as well. So across the board, from the manufacturers, from the producers to the consumer, we are seeing relative price cooling year over year, with inflation coming in at around 3.3%, which is among the lowest we've seen in the past 12 months. But that's still inflation of well over the Federal Reserve's target of 2%. So it's not time to start celebrating. It's time to, assure that you and, individuals and businesses have the financial wherewithal to endure some more inflation, probably for another 12 months. It won't necessarily be out of control if we trust what the Fed is doing and we trust the results that they've produced from tightening. I'm of the higher for longer camp. I think we're going to see, inflation that's high but not out of control for a longer period of time than folks are anticipating. The market is really eager to watch inflation come down, is really eager to watch the Federal Reserve lower interest rates. In fact, Goldman Sachs this morning releasing a note that they think that the Federal Reserve will cut rates in the second quarter of 2024. And we will see. I think, the exit plan, the global exit from this inflationary period of the last year and change will determine kind of the next 10 years, I think, in the business cycle, because we're seeing a lot of concerning things. On one end, Japan is looking like they're going to raise rates or float rates, meaning they're going to let inflation enter the country. They're going to let interest rates rise and to try to damper it. On China, we're seeing kind of a credit crisis that's been going on for a year. Real estate debt's going bad, personal loans going bad, business debt going bad. It's been a little bit of a domino effect, and the government has to buoy it. Otherwise, simply they will struggle to be a going concern. Their growth rate is close to 2% when they are mandated to grow at 8%. Otherwise, people in China suffer. They either default on businesses, or can't, have to give up things that took a long time to own, can't access the right stuff, can't access capital correctly. It is a precarious position for China, and they're likely going to enter an easing cycle. They already have, but they're going to more aggressively dive into an easing cycle to try to improve economic conditions domestically. But we'll see how that goes. One of the questions I have is whether China will end up turning into a Japan, needing to rely on really cheap money to just keep breathing, and struggling to see growth on a continued basis. On the other hand, I have the same concern for the US, who's dealing with something different. And, we have proven here over the last couple of years that the US can grow under inflationary pressure, but it's suboptimal and the market gets a little bit jittery. So, out of the three sort of major economies of the world, US, China, Japan, I see a risk of Japanification for the United States and especially for China right now. But where's Japan going to go? They've struggled with economic growth, they've struggled with inflation appearing in their economy, and it seems that they are very, very slowly shifting policy around and shifting perspective around to try to shake things up over there in the Pacific. They have some serious structural issues, comes down to population, comes down to birth rates, social issues, attitudes towards work, attitudes towards innovation, attitudes towards outsiders participating in business. So lots of sort of macro challenges, but I think the exit of this inflationary cycle will reposition these three major economies in a material way. That's my sort of big exciting thesis here going into a longer term view. That's all I have this week, guys. We'll catch up, or this Monday. We'll catch up on Wednesday. We'll catch up on Friday. This week, I want to dive a little bit deeper into some new opportunities. Last week, we talked that we were actually going to cut in half our pen position in the model portfolio. So we'll likely break out into a little bit of a model portfolio intensive for those that are interested. And of course, we'll keep sharing what we're looking at, what we're reading on the Discord. Take care, guys. We'll catch up soon.